Will 2026 be as good as last year for Wall Street's M&A bankers? I think it might be. Here's why. By my count, Wall Street's mergers and acquisitions advisors earned almost $15 billion in fees across the top 5 Wall Street banks last year. That's a really good year. It's not quite as good as things were in 2021, when there was kind of that post-pandemic catch-up, but overall, it was still a pretty extraordinary year. But now, political uncertainty is re-entering the chat. Affordability kind of seems like the name of the game. And you've got domestic policy ideas like President Trump's thought to cap credit card interest rates. You've got geopolitical uncertainty, what's going on with Venezuela, with Venezuelan oil. These are the kinds of wild cards that historically have given pause to decision makers when it comes to things like launching big deals. The biggest US Wall Street banks reported strong earnings this week, but some of their stocks are tumbling. I think, though, that investors should remember the lessons of 2025. While President Trump's Liberation Day tariffs drove a surge of volatility and seemingly put some deals on hold, ultimately, the urge to merge won out. According to LSEG, whose data goes back to 1980, last year there was a record number of transactions valued at $10 billion or more announced globally. Goldman Sachs, which made the most money from M&A advisory fees last year, said that its pipeline or backlog of coming investment banking activity was at a 4-year high. That's a really important data point. The bottom line is that companies still seem to think it's a really good environment to do deals. Not to mention the fact that there are thousands of privately held companies that will at some point need to find an exit. Some of them might go public, some of them might get sold. Either way, it'll probably be a busy year for Wall Street again in 2026.